Well, early going, it seems like investors are feeling pretty optimistic. Stocks moving higher. Are recent gains justified, though, with the outlook for the economy? We put that question and a few others to our next guest. Fritz Meyer joins us. He is senior market strategist at Invesco Aim Advisors. He is joining us from Bloomberg's Toronto studio. Fritz, glad to have you with us. Jobless claims number came in at 584,000, so that was higher than forecast, but under that key 600,000 level that so many people said was important to get beneath. So do you think we see stabilizing in the labor market, or too early to make that call?
No, I think this data series, unemployment claims, is a very important one, and the important aspect to this is the downward trending pattern. And now we've seen probably 6 weeks of a downward trend in unemployment claims. That historically has been fairly effectively, fairly accurately pinpointed the end of recession. So the unemployment rate will very likely continue to rise, but unemployment claims probably signify that we're exiting recession and back into recovery.
So what does that mean then, for example, for third quarter GDP? I mean, most economists about a month or two were looking for just marginal growth. Do you think we can be more optimistic?
Yeah, what's interesting is most recently, many economists actually are taking up their GDP forecast for the third quarter just slightly. The consensus until recently was about 0.9 or 1% GDP growth estimated for the third quarter, and now many of these of the best economists are taking that up towards 2%. That's a very positive, favorable shift in sentiment.
What about some of the pretty big and qualified voices out there that are still mouthing caution? Janet Yellen is one who comes to mind, saying, you know, even if there are encouraging signs, the economy could stay weak for a protracted period. She highlighted problems with commercial real estate, as did Sam Zell. So, I mean, there's still a lot of headwinds out there, are there not?
No question about it. Yes, there are lots of headwinds. I think most economists are, in fact, projecting or expecting a muted recovery. The consensus right now is for recovery to just 2.9% GDP growth 1 year out, and that, by historic comparison, would, in fact, be a very muted snapback from a depressed base. But remember, too, that public officials really do need to sort of dampen their enthusiasm, because I don't think anyone wants to see the Federal Reserve take the monetary stimulus back too soon. And so that's part of the motivation there, I would guess.
Fritz, I'm just curious. I mean, how do you perceive the earnings season so far? I mean, today we have more than 50 companies from the S&P 500 reporting results. There are some who point out that earnings have looked pretty good in most cases, but it's because companies either, in some cases, understated tax rates, or they just slashed and burned their way to better bottom lines. In other words, revenue still moving lower. What's your take on what you've seen so far?
Right. Soft to very little to zero revenue growth, but better than expected profits, and that's a pretty universal phenomenon. 75% of companies that have reported so far have met or exceeded the estimates. That in itself is a very good statistic, compares very favorably to the historic data. What I like about this situation is...
Even if they're managing their earnings, Fritz?
Sorry?
Even if companies could be accused of managing their balance sheets, managing the earnings.
Right. They're very definitely managing earnings through this soft period. But what's important here is that when we do get an increase in revenues with economic recovery, I think we're going to have a very strong profit snapback, because companies have done so well managing costs through this downturn.
Fritz, we thank you very much. Fritz Meyer there joining us from Invesco Aim Advisors. Betty?